patterns are usually converging trend lines over 10 to 50 trading periods. Trading periods doesn't mean that it has to be 10 days. It's not limited to days. 10 to 50 periods. So going back to the next pattern is the flag. So what's a flag pattern? It's basically a price pattern in a shorter time frame, and it moves counter to the preceding price trend. Okay, so we'll see it in a bit, what exactly that means. And flag patterns signify trend reversals or breakouts after a certain period of consolidation. Um, and flag patterns can be either upward trending, like breakouts as a bullish flag, or a downward trending breakdown, which is a bearish flag. Like how we had three main characteristics for wedges, flag pattern has five main characteristics. So it's very important to keep in mind these five main characteristics for the flag patterns. The first is, uh, preceding trend. It's counter to the prevailing, whatever the price trend is, and it needs to have a consolidation channel, a volume pattern, a breakout, like as we see in a rising or falling wedge. And there was a breakout, right, on a trend line. And the fifth one is a confirmation uh, that the price is moving in the same direction where the breakout took place. The first thing is preceding trend, consolidation channel, volume pattern, a breakout, a confirmation where price moves in the direction of the breakout. All right. So what's a bullish flag? So price action kind of, rises during the initial trend move and then declines through the consolidation. This is consolidation. Right? It's consolidating like a box. The breakout might not always have like high volume surge. If you were to see the bullish volume pattern, doesn't have a surge, but most of the traders kind of like prefer to see um, uh, because it tends to imply uh, that the other traders have entered the stock, and then you can see a enthusiasm in falling prices. Um, so if you were to look at it, it kind of like rises. Basically, this is the pole. This is the consolidation area is the flag. The breakout generally might not have high volume surge, as you can see here. Let's take a look at the flag. Kind of looking. So this is, let's say this is the pole. Try trend line. Consolidation channel. So this is the flagpole. This is the channel, right? So 5 characteristics, right? We just saw preceding trend. It's the reversal of the preceding trend, and a consolidation happens. A volume pattern, as we saw in the bullish flag. And a breakout to the consolidation channel, and confirmation of the price move in the same direction as the breakout. So it's breaking out here. Go to the line chart, to the candlestick. So this is the flag, this is the consolidation area. So the flag is the consolidation channel, the volume, the breakout through the trend line, through the consolidation channel, and the price kind of follows this breakout trend line. But some trader is they kind of just like make a rough estimate. Let's say the bottom of the flagpole is, let's say, 71. Let's say top of the flagpole is like 77. So generally, like just like a rough calculation. So this difference is what, like 6, and whatever this number is here, the close was 78 or something. And if you were to add this difference of the flagpole to this, say 84 or 85, that gives you a price target. Around 85 or 86 here. So generally, price target is an estimation in the future based on the patterns or the indicators. Like for example, when we did the head and shoulders, the inverse heads and shoulder, we came up with a price target. Whatever was the difference between the head and shoulder, we added that to the shoulder. That kind of gave us the bullish price target. Yeah. So similarly, uh, what traders do is they don't jump here. They kind of wait for a day or so until it breaks out through this consolidation channel to kind of just like confirm that it's heading in the right direction. That it's definitely a bullish flag, not just a false signal. And when you go to the bearish flag, it's just opposite to it. Instead of if like in the bullish flag, we have a flagpole and then flag in a consolidation channel in a breakout with a volume pattern here. On a bearish one, what happens is volume does not decline during the consolidation. It stays flat. And the reason is that, the bearish downward trending price moves are usually driven by, volatility, fear, anxiety about falling prices. The further prices fall, the greater the urgency that investors feel to take kind of like an action. So again, this is a flagpole consolidation channel with the volume pattern that you see, just like pretty like approximately flat. You don't the volume does not always decline during the consolidation. So stays approximately flat. So, so let's take a look at an example for a bearish flag. Looking at Nasdaq 100 new features. So look here. So what's the best way to kind of like find the volume and stuff? Just remove this HNA. And if I go to the volume. I just want to understand what the volume trend is. So this is the volume, right? I just turned it on. Yeah. So this is the volume, right? So I just turned it on just to kind of understand that point, that the volume does not always decline during the consolidation, right? So the inverse flag, it's a bearish pattern. Let's say, drawing this line, right? So to have consolidation channel, two trend lines, right? So flagpole, two consolidation, two trend lines forming a consolidation channel. Right. If I were to look at the line chart, it breaks through this consolidation channel. Five main characteristics for the flag pattern is it needs to have a reversal in trend preceding price trend, consolidation channel that we drew by the use of two trend lines. And then if you look at the volume does not always decline during consolidation. So the volume does not decline. Generally, in this case, it's just like an approximate. See this? And the other characteristics, it has a breakout for the bullish flag. For the bearish flag, it has a breakdown. For the bullish flag, it has a breakout. So breakdown. As we see here.